I'm just going to say this up top. We're offering 12 custom creative demand model builds right now for free to brands that are in the 8-9 figure range. Now, to just give you like a really quick summary of what that is, a creative demand model essentially gives you the sense of, given a certain spend, like budget goal for an upcoming month, let's say, how many ads are you going to need to create in order to reach that goal? That's the simplest way to explain that. And what we're going to talk through today is exactly how the creative demand model and then our spend and AMER model, which is again the overall forecasting model for new customer acquisition, how those things for a specific client, we're going to do kind of a specific case study here, how that impacted their upcoming Q4 strategy. This episode of the e-commerce playbook is brought to you by Portless. Your competitors are panicking. Their holiday inventory is sitting on a container ship somewhere in the Pacific, arriving maybe by late November, but not you. Your inventory just finished production yesterday, but it's ready for sale tomorrow. With direct fulfillment logistics from Portless, cut your inventory lead times by 90%, meaning you start generating cash flow immediately, not in late November. Think of it like a China-based 3PL, but with a North American delivery experience. Here's how Portless gets you selling for BFCM faster. Onboard inventory from your factory in 2 to 3 days, not 60 to 90 days. Start selling immediately while others wait for containers. Generate cash flow now to reinvest in BFCM marketing. Restock winners in 3 to 5 days throughout the entire season. With Portless, you'll be months ahead of brands waiting for containers. That's extra months of sales, reviews, and cash to make this the best BFCM ever. The math is simple. Start selling your products in days or wait till November. Head to portless.com today to get your free quote and see how direct fulfillment can transform your business. That's portless.com today. Hey folks, welcome to the e-commerce playbook podcast. I'm your host, Richard Gaffin, director of digital product strategy here at Common Thread Collective. And I'm joined today by our VP of e-commerce strategy here at Common Thread Collective and my co-host on the D2C Hotline podcast, Mr. Luke Austin himself. Luke Austin, our war reporter, our e-commerce or growth strategist extraordinary. Luke, what's going on, man?
What's going on? The gap between the Q3 to Q4 sort of progression, and specifically this October month, is just fascinating, because it sort of sits at the intersection of wrapping up Q3. Q4 feels really real and the plan associated with it, and then also 2026 is right around the corner.
I know, it's crazy.
It feels like, if we had like, it's sort of like playing Twister, I guess, where you have like one arm over here and one arm and then one leg over here, and it's like, okay, let's like try to balance in this position.
Yeah, that's right. It's just sort of like playing Twister while you're like on the roof of a train or something like that. It's just like it just never stops moving. But all right, I mean, but essentially that's what we're here to talk today about, is sort of like untangling that mess. And particularly what we wanted to point out is a couple things. So one, and I'm just going to say this up top, we're offering 12 custom creative demand model builds right now for free to brands that are in the 8-9 figure range. Now, to just give you like a really quick summary of what that is, a creative demand model essentially gives you the sense of, given a certain spend, like budget goal for an upcoming month, let's say, how many ads are you going to need to create in order to reach that goal? That's the simplest way to explain that. And what we're going to talk through today is exactly how the creative demand model and then our spend and AMER model, which is again the overall forecasting model for new customer acquisition, how those things for a specific client, we're going to do kind of a specific case study here, how that impacted their upcoming Q4 strategy. So they came in, they had a plan for Q4, they had some expectation of what they were going to do. We ran these models and discovered that actually their strategy and their approach was going to need to be radically different. So we want to talk through kind of exactly how that works. So I'll turn it over to you, Luke. Let's dive into it here.
Yeah, so I'll tee it up. Again, we're going through a number of these projects right now related to building out profit systems for Q4 immediate impact, as well as 2026 planning. And so we're having a lot of these conversations, and they're a lot of fun, fascinating, like what the output and the outcome is of these processes. So what I'm going to do today is actually show one individual brand and what the result of engaging in the profit system and building out the spend AMER model and the creative demand model, which are four of our core models that exist within the profit system. So 2 of the 4 models we'll walk through: spend AMER model and creative demand model, and what impact that is leading to for this brand. Their Q4 strategy is different now than it was 3 weeks ago prior to us engaging in this process. And so we'll walk through what that output looked like for them specifically and what is changing.
All right, let's do it.
Okay, so for those listening, watching in a visual format, we'll be sharing the spin AMR model and create a demand model on screen, and then the listening in will be chatting through all the pieces. So I'll pull that up so that we have something we can reference and go from there. So the spin AMR model, as a reminder for those, the spin AMR model or spending power model is the model that we have created. It's an ensemble model of over 30 different models that look at historical degradation, efficiency, seasonality. We even look at Google categorical search trends, 30 different models that we then ensemble into one master model, an ensemble model, the spending power model that helps us have the highest confidence that we can in terms of what new customer revenue and contribution margin to expect at varying budget levels. This is for us to help in the process of total budget allocation. What is the optimal amount of total budget that I should spend in a given time period to maximize against the business objective I have set for that point in time? And so there's sort of three out of the box optimization selections that we've built the model around. The first is maximize contribution margin in month one. So I want the maximum contribution margin dollar volume for my first time customers month one. The second is max revenue from new customers at break even CM. So I want the maximum amount of first time revenue at break even on first order. And then the third is I want the maximum amount of contribution margin but in a defined LTV period. So I want the maximum contribution margin, but I'm willing to wait 60 days, 6 months, a year to realize that. And I don't need that directly in month one. And then what we're able to see is each of those different optimization scenarios you can see sort of here in the table below. What we have built out is this chart where you can see the degradation curve for any point in time. But then we have a table laid out where we can see for every additional $10,000 in spend for this brand, what is the incremental AMER of that additional $10,000? And then what is the resulting new customer revenue, new customer contribution margin, each of these intervals so that we can land on budget that again is best suited for the business objective for that point in time. So that's spending power model at a high level. Now, what we do is we build this model as part of the profit system. And what we like to look at first is what is the current budget allocation of the business or their current pace for the year prior to any of our recommendations and any of our perspectives, sort of like have a comparative state. And what we have up on the screen here, and we'll talk through first, is the brand's budget allocation for Q4 prior to engaging in conversations with us and building out the profit system. So they were planning to spend total over the course of Q4, $1.24 million in total spend. And you can see here in October, $387,000 was the budget for that month. November was $404,000. December, $454,000. The aggregate of those 1.24. So aggregate 1.24, 387, 404, 454 for each of those months. And we can see the resulting new customer revenue for each of those cohorts: 600K in October, 800K in November, $1 million in December, and the contribution margin for each of those months as well. 123K in contribution margin in October, 300K in November, 330K in December. Now, as we look at this, the thing that becomes very immediately apparent, and in some of those numbers, it may have jumped out to folks, is AMER, the acquisition efficiency in each of these months is very different based on this current budget plan, right? So in October, again, the current budget plan prior to this process would have spent $387,000 to drive $621,000 in new order revenue. That's a 1.6 AMER in October. So 1.6 AMER in October. November, their plan was to spend $404,000. So that's $17,000 more spend, right? But like basically flat month over month spend from October, but to drive $857,000 in new customer revenue to 212 AMER. So October AMER at 1.6, November AMER to 212, basically flat budget allocation between those months, wildly different outcomes in terms of the new customer revenue and contribution margin. And then December actually increases slightly more spend than November, but the AMER is yet higher than November at a 222 versus the 212 the month prior. And this was sort of the first part of the exercise of us identifying opportunity and being able to see that there's likely opportunity as it relates to the budget allocation in total, but also the budget allocation between each of these months relative to the AMER efficiency and the discrepancy we were seeing on a monthly level.
Portless helps e-commerce brands speed up their supply chain with direct fulfillment, a fundamentally new way of managing your supply chain that provides faster sales, better cash flow, and more inventory agility. Fulfill customer orders from Asia within 5 to 6 days, providing a total domestic experience, including local labels and tracking numbers. Portless users cut their lead times by 90%, increase cash flow 3x, and can ship to over 55 countries, helping fuel their growth and international expansion. Ready to transform your supply chain and make logistics a competitive advantage like Temu and Shine? Go to portless.com and get a free, no obligation quote from the Portless team. That's portless.com. Gotcha. So, I mean, to kind of reiterate a bit of what you're saying, like the thing that jumps out to me is that, like, as you grow spend, I mean, even though like October, November is flat, but November, December, there's a bit of growth. As you grow spend, the expectation ought to be that MER would go the other direction. So is that, so I guess kind of beyond that, what's the opportunity here? Is it to spend more at a lower AMER, or how does that play out?
Yes. So the second part of this process then becomes, okay, we have an understanding of the current state of the business. We have the model built. We understand at these budget levels, we have clarity on, okay, brand A, if you were planning to hold your budget level consistent, this is what you can expect for your new customer revenue, right? And then there's some gap that exists.
Mhm.
Then what we get into is the second phase, which is how could this look different to improve the business outcome for this month? And that's when we start to look at the model output for each of these months and start to identify that based on max contribution margin or max revenue, whatever the optimization scenario that we're going for, what the optimal allocation for each of these months is for the business. And so we'll highlight a couple of these to sort of illustrate the point. October, the brand's existing budget allocation optimization is $387,000, right? Okay, so that's what they're currently planning to do. The max contribution margin recommendation from the spending power model is $196,000.
Hmm.
So that's a cut of $195,000, somewhere in that range, a substantial cut in the ad spend recommendation for October. Okay, so 387 down to 196. Now, let's look at December. December, they're planning to spend $454,000. The max contribution margin optimization. So again, the same thing. We're optimizing for maximum contribution margin at the business objective that's staying consistent between these months. In December, they're planning to spend $454K. The model's recommending they spend $488K in that month for the same optimization selection. So what we just did is, if the goal is to maximize contribution margin in month one, what we identified is we should cut almost $200,000 in planned spend from October and allocate some of that to December. And then the same story holds for November as well, where they're currently planning to only spend $404,000, and the model's recommending for max CM to spend $461,000. So that's the second part of this process. The current state, what clarity on what new customer revenue and contribution margin outcome your current spend will have for the business. But then the second phase being, okay, if we are going to optimize this against the set defined business objective, then what should the optimal spend look like? And in this case, the movement is a lot less budget in October than planned, and there's a lot more room to run in both November and December against the current trajectory of business.
Yeah. Let's jump back to October real quick, because I want to highlight this for our listeners too, like make this kind of particularly clear. So what are they planning on spending in October here? It's 400.
October is planned spend
high 387.
Yep.
Okay, so let's look at what the model would spit out. If they spend 387K, what would their contribution margin be? So 124K.
Yep,
right?
124K in contribution margin. That's right.
Okay, and so they're recommending, our model rather is recommending that they spend 196K, which would result in 185K, 0.7K in $185,700 in contribution margin. So the idea, like what we're pointing out there, is that if they were to reduce spend by, as you say, about 90K, they would actually increase contribution margin by, what is that, about 60K ish, right?
Yes.
So that's kind of like the revelation here that this model provides, is the idea that you would make more money on the bottom line if you spent less. And once that we have that sort of understanding, because the model can reveal that to us, then all of a sudden the way that we distribute the budget across those months has to change dramatically in order for us to achieve that goal of maximizing contribution margin.
Yes, that's exactly right. And this is further highlighted when you look at the new customer outcome between these levels of spend. And this is the thing that what in this conversations where we deliver the profit systems and talk through the spending power model, the thing we always communicate is the spending power model has yet to deliver a result for any brand that's sort of a recommended incremental change to your current business. Like,
Mm,
hey, just like tweak 5% here or there, and like
yeah.
that's an improvement. Which, by the way, 5% against millions of dollars of ad spend is still a meaningful impact, right? So, not to sort of diminish that, but typically, what the model recommends is like spend 40% less in this month and ramp up 60% in this month, right? Like
Yeah.
a much more wild outcome. And the the reason for that is the way that efficiency degrades in every month. There's a different relationship for every brand for every month, which is what the
Mhm.
spending power model is ultimately getting at. And the incremental AMER for each of these incremental $10,000 levels of increased spend is diminishes much more quickly than most folks realize. And so the
Mhm.
October example that you just walked through, so the max contribution margin scenario, the model's recommending 196K in spend, expect 465K in new customer revenue. Okay, so 196K for 465K in customer revenue. They were originally planning to spend $384,000, and the new customer revenue outcome would have been $621,000 in terms of the recommended new order revenue. So 384K for 621
Mhm.
or 196 for 465. So they would be spending $180,000 of additional ad spend for $160,000 in additional new customers
Right.
if they had stuck with their original budget plan. For a brand that has substantial increase in LTV, repeat purchase behavior, built-in subscription, whatever it might be, that's a trade-off that many would take any day of the week, sort of thing. Like, okay, cool, like a point nine AMER, like that actually works out for us in 90 days. But for this business, there is that dynamic that exists, and
Mhm.
that's not a trade-off that makes.
Right. All right. So with those kind of like that discrepancy between the old model and the new model established, so what are the next steps then?
Yes. So the discrepancies are established, and we're seeing this trend of there's more opportunity in October, November, and December. Now, there's a whole other layer of this related to the marketing calendar and the event effect model and how we think about those moments. Just for the sake of time, I'm going to sort of breeze over lightly, which is we see this, the current state, we see the dynamic of shifting the spend between October, November, and December. And then what that starts to bring up is conversations around how we can adjust marketing calendar moments to further sort of build upon or exaggerate this impact for business. And so what we ended up doing for this time period was not just making these initial budget reallocations between October to November, December, but we actually moved forward with replacing last year's 50% Black Friday, Cyber Monday offer with a BOGO offer, and then bringing spend down in October and in November and December compared to what they had done in 2024. So based on, again, the marketing calendar and VinEffect model, we've talked about this in previous conversations. We won't get into those specifics. So based on the impact we had seen of historical marketing moments on driving volume and efficiency at the levels that we needed to see, BOGO offers heavily outperformed against 50% relative to the marginal profile of these offers and the amount of volume that we can drive from them. And so, in addition to pulling the ad spend away from October, then the movement was let's adjust the marketing calendar and offer strategy in November and December to align around this offer that has higher impact based on the effect that we've seen in the marketing calendar event effect model. And that's how we landed on the final plan recommendation for them, which we have here. And I'll talk through sort of briefly. So, what we landed on was October, we cut budget back by about $80,000 relative to their initial plan. And then November, we increased from $404,000 original plan to $563,000. So we increased
Mm.
$160,000 in the recommended output for November. And then December, $454,000 to $670,000. And so the net impact of the spending power model combined with the adjustment in the marketing calendar events for the business resulted in over $200,000, $220,000 in incremental spend for this time period, and resulted in over $400,000 in incremental contribution margin and about $700,000 in incremental customer budget allocation, aligning with the highest impact moments, and then adjustments to the marketing calendar and the effect of those events. Adjusted spend between the months, more spend overall, more new customer revenue overall, and higher contribution margin over the course of Q4 that we can now expect that's built in.
Right. Okay. So you sort of pointed out how we've shifted the expectation because
Yep.
there's clearly opportunity there. And you started getting into this a little bit, but let's unpack it more, which is obviously if you do nothing except business as usual, this isn't going to happen. The adjustment to the plan means an adjustment to behavior. So you already mentioned switching up the offer, switching to a BOGO, which obviously would be better for margin, which impacts the contribution margin number. But what other changes have to be made in terms of behavior over these next 3 months in order to bring about this change other than just kind of like turning up the spend or whatever?
Yeah. So the the expectations are set. We have daily targets that then are set against these. So the execution, to your point, has to map against that on a daily basis. There's downstream effects now with the marketing calendar on the email and SMS calendar and the send plan associated with those things. So there's sort of a few buckets worth of things. But I think the the main impact as it relates to from a planning perspective that then this leads to in October is we're planning to spend $220,000 more than the original budget plan and shifting a
Mhm.
lot more of the expectation in November and December. Yes, the marketing moments are going to propel that, but we need additional fuel within the ad accounts and specifically Meta, which accounts for the majority of the spend, to be able to drive that outcome. And so the question becomes naturally, how much additional creative volume do we need to be able to achieve this plan, knowing that we're pushing incremental spend in a different way than we had originally. And so that's where the creative demand model comes in for us and helping us to answer that question of exactly how much creative do I need to hit the spend forecast that I have for the coming time period. And the creative demand model, so to give the sort of high level overview of this, we've sort of unpacked it in a few different episodes at this point, but just as a refresher, the creative demand model is adjusted based on all historical performance data across the account, and we look at 5 different core creative metrics as the output. We look at zero spend rate, which is the percentage of active ads that had zero spend during the measurement period. We look at ad concentration, the percentage of total ad spend concentrated in the top 5 performing ads. We look at ROAS degradation and spend degradation, which is the change in spend and ROAS after the initial launch week, the improve or degrade after the initial launch week. And then we look the 5th metric at evergreen share, which is the percentage of ads that have been running consistently for 30 plus days. These are your sort of evergreen stable foundation of the account. So we build out the creative demand model looking at these 5 metrics and we benchmark against our broader data set. And that culminates in, for every brand, a creative score. And the
Mhm.
creative score is the combination of those 5 metrics. And it is a percentile rated metric where if your creative score as a result of these 5 creative metrics is above 50, that means that you are going to need to create less ads than you did historically in the coming time period because the efficiency of your media relative to your creative performance is improving over time relative to some combination of those 5 metrics that we
Mhm.
walked through. So above 50, you're going to need less creative volume. You're doing better. You're going to need less to get to where you need to go. Creative score below 50, you're going to need more ads than you did in a similar historical time period to achieve the same outcome.
Mhm.
So if we are needing to spend more than we did last year, which is what the outcome of this Q4 plan is, spending more than we originally planned to. And what we have up here is the creative demand model output for the same exact brand, and their creative score is a 43. That means we're going to need to create more ads, even if we were just trying to spend the same amount because our creative score is below 50 at a 43, and we're needing to spend more in total. So it's sort of a double whammy on the additional ad creatives that we're going to need to output to be able to get to the spend goal for the quarter.
Yeah. So yeah, in other words, like if they were to have spent, let's say, 20% more than plan last year, or $500,000 or whatever it would be, they would have required less ads to do that than they would this year, given the way that some of these metrics are kind of have shaken out. So obviously they have like a very
Yes.
strong kind of suite of evergreen ads, let's say, but across the other metrics, what it's sort of showing is like the degradation of specific ads is like maybe relatively high, zero spend rate, for instance, meaning like what percentage of ads get zero spend at all. So because of those factors, there's going to be some percentage tacked on top of the increase in spend of extra ads that need to be made in order to hit those numbers. So what are those numbers? What does that look like?
Yeah, that's exactly right. So a couple different ways that we can look at it. So we have the specific number of actual ads that need to be created for October, November, December to hit the goal. So I'll talk to I'll say those numbers really quick. In October to hit the spend budget, this brand needs to create 303 ads. In November, 618, and in December, 345. So that's the total between those 3 months: 303, 618, 345. That, as an average, is right around 323 ads, I believe. So 452 ads is what they need. 323 ads is what they've been creating. So they'll need, on average, over the course of Q4, 452 ads per month. More than sort of loaded into November and December, but you want to get started on the production in October, so you need to launch this in 2 weeks. So 452 ads over the course of October, November, December, on average, is what's needed, broken out by each of those months just talked through. And they have been creating, over the recent months, an average of 323 ads per month. And we can see that here in the chart in the creative demand model, where we're able to see actual ads created. So actual creative, net new creative ideas in the account for that time period, actual ads created versus the optimal ads to create for each of these months. And this brand is really strong in terms of the creative output relative to what we see on average. Creating an average of 323 net new creative ideas within your ads account on a monthly basis is really strong. And for some of these months, they've been creating the necessary or even higher than the necessary. Now, what's happened is in September and in October so far, the actual ads created has been lower than what the expectation is. And so we need to ramp heading into the rest of the year. But the headline here is you need 452 ads on average. The recent months, you've been creating 323 ads on average. So you're going to need about 120 more ads outputted every single month over the course of Q4 on average to get to your spending. So we need a production plan, and we need a strategy to be able to increase ad output 120 additional ads above the current average baseline of what our creative system has been.
Right. So yeah, obviously, like there's some really clear action steps that come out of this, and some particularly urgent ones as well. Like the sort of immediate action that needs to be taken over the next 30 days is to figure out for this brand the production, how to pull the levers in their creative production side to actually get to that extra 100 and something ads per month, right? Which is a significant amount. Um, so but I think, like, to summarize then, like, there's a very clear path here from this is what they thought was going to happen. This is what the model revealed pretty clearly needed to happen in order for them to kind of hit the goals for their business, which are around contribution margin. And then gives them a sense of exactly like the volume of execution that needs to happen in order for them to get there, which, as it turns out, is much greater than their kind of original expectation, or rather their original, like the original capacity of their creative production machine. So, I mean, I think that this is like overall just like such a great example of what the spending power model and the creative demand model kind of reveal for brands, is that like there are some real gaps between what they're currently doing and what the potential is. And I think these makes these really clear. So,
Yeah.
so kind of what comes next then for them? Is it just like, hey folks, got to ramp up creative production, or like what else do we
So
provide after this?
so two things come next. So we have the monthly sort of P&L level forecast for each of these months built out. But then what we have is daily targets already set in the course of October that we are now partnering with the brand in tracking against those on a daily basis to be able to make sure that they get to the outcome they need. So what we need to do is track every metric every single day to make sure we stay on track for this plan. Because if we're pacing 15% behind October's expectation, when we go to update the model and reforecast November, December, there's going to be a higher expectation that's right? So don't get behind the plan is the first sort of item coming out of this. We locked in the plan. Now let's go execute on it and make sure we don't start falling behind in any area on a given day. And then relative to the marketing calendar, there's a whole sort of subset of activities coming. The conversation we had with the brand last week, they had all sorts of things in production and design relative to the 50% off offer that's getting switched to BOGO offer, right? So there's like all sorts of things that need to be adjusted there on the website and the codes and the design materials, et cetera, that it was an immediate action item. And then the other piece is on the creative demand that needs to get in production as well, which is already rolling. Combination between what their internal team is doing and then potentially with us supplementing what that looks like. But the thing I'll add to the earlier point that you brought up, Richard, which is there's additional creative investment that needs to be made to get to the goal. But we've just created a few $100,000 of income contribution margin that's going to help sort of fund that investment into these additional areas, which is the important thing, which is like what we have many conversations that the output is different than this example, where the output is actually spend less overall because you're so far past your level of efficiency degradation on the AIM curve. And those conversations, it's important to make that initial adjustment. But the even more important thing after the initial adjustment of pull back and be more efficient is now you have saved those dollars that you were going to spend at a very low incremental AMR, redeploy those dollars into growth, into areas through creative volume and diversity, net new channel expansion, specifically more diverse creative so that you can improve your AMR curve, so you can improve against the model, and then net new channel expansion, launching AppLovin and YouTube and some of the channels that we're seeing produce the most growth. Redeploy the dollars that have been saved to go and improve the model, because that's the whole thing we're all after. Is we build the model, we set a really good expectation, but what we're almost interested in is going to beat the model. Let's improve the business outcome so we don't continue on this trajectory. So we've identified where we can reallocate and improve the contribution margin, and we've actually saved some dollars in October. Those need to be reinvested for growth to make sure that we stay on plan for the rest of the quarter.
Yeah, right. So what you're saying is essentially this plan puts the cash in your pocket that you would need, the very simplest way to put it, the cash in the pocket that you'd need to invest in the creative production that you would need to hit the numbers that you're planning for, basically,
Yes.
right?
Yep.
So, and to your point, I think it's important to highlight that the original plan basically had them blowing almost 90K in spend on Meta, right? I mean, that's pretty much, frankly, what it was. Like you could see on that report that the incremental ROAS on each one of those like tranches of 10K or $1,000 or whatever it was like 0.57,
Yes.
which means that every dollar spent over that kind of original amount was lost. They were just sort of throwing it away.
Yep.
And so now what we've done is readjusted it. So they're not throwing that 90K away. That can be reinvested in a manner that's actually going to generate more cash so that they can kind of make the investments that they need to make. So
yes, that's exactly right. And there's most brands have a list right now of ideas and desires in terms of new investment areas, new campaigns and creatives and channels they want to expand to, and things. Understanding how much budget they can actually save and reallocate in some places to deploying those without having a meaningful impact on their top line or the contribution margin is the first critical step. So to your point, going into Q4 and the planning, and then also going into 2026, that it's getting clarity on that is one of the most critical first steps in this process, so that you understand, okay, what is the necessary budget that I need to spend to maintain sort of the baseline expectation of where I want to go, right? But then there's going to be some delta between where you're currently at or pacing to relative to that then becomes, okay, this is what we can think about as the budget that we can reinvest into growth, into net new things that are going to improve the model and improve the business trajectory against our client baseline.
Yep. All right. Anything else you want to hit on this, Luke?
I don't think so. I think we covered all of it.
All right. Love it. Cool. Well, if you want us to do this for you, we're giving away 12 creative demand models right now for brands that are in that 8-9 figure range. If you're interested, commonthreadco.com, hit us up, hit that hire us button. We would love to chat about building one of these things for you, because as we pointed out here, and we've said on the pod many times, the likelihood that you're under or overspending by a lot there's a high likelihood. And this is going to reveal that to you and kind of show you exactly the path that you need to take to get to actually a plan that's going to maximize the business outcome that you're interested in. So check it out. Give us a call. We'd love to chat. And until next time, take care, and we'll see you next time. Bye.